So welcome to fundamental of financial accounting. Welcome to accounting. Accounting is said to be a very interesting interesting course. What I will want us to understand in this fundamental of financial accounting is that we'll be dealing more of what of the rudiments of rudimentaries of accounting. Taking us through the double entry principles in accounting. The basis of accounting, and from there we'll be moving up. We'll be developing on the basis till we get to to our final destination. So what I will implore us at this point is to listen attentively, pay rapt attention to it, and as you do that couple should listen to this tape over and over. I know by God's grace that the success will surely be hard. So I will try to take my time to explain this deeply, to give you good understanding of fundamental financial accounting. And even for non-accountants, are able to listen to this, I know by God's grace will surely get there. And that's just it. So, you want to ask of my name? Not necessary. Let's continue. Now, let's start with the fundamental of financial accounting. Now, when we say financial accounting, what do we mean? Now, the history of accounting started right from the word. Let's start with the history, please. The history of accounting started right from the word, from the beginning, when the word we are on fundamental of accounting, sorry. The history of accounting started right from the word, from the beginning, when the world was created. Now, business transactions were in low volume during that time. Hence, the need for keeping data. And hence, the need for not keeping data. So, there is only for keeping data because of the volume of the transactions was in the low year then. Now, as business firm increases, the volume of transaction tends to increase, thereby resulting to loss of information because of its not recorded. Now, because of as we move on, then the volume of transaction begins to pile up, and with that there is loss of data because transactions are not recorded during those periods. However, the recording of transaction in books of accounts, that is bookkeeping in line with double entry principle, dated back to 14th century, when Italian merchants begin to use the double entry system to record their transactions. Now, the earliest known double entry records were introduced by the Italian scholars named Reverend Father Luca Pacioli, who published the first known text on double entry accounting. So what we are just saying here is that the accounting, in a nutshell, the double entry principle in accounting, the double entry recording of transaction in organizations in accounting, started in 14th century, dated back to 14th century, by Reverend Father Luca Pacioli, who published the first known text on double entry accounting. Now, that's just by the way. Let's look at bookkeeping and accounting. What's bookkeeping and what's accounting? Now, when we say bookkeeping and accounting are mostly used interchangeably. So mostly people look at bookkeeping and accounting as somewhat the same. Bookkeeping and accounting as well as being the same thing. But in a nutshell, in the real sense of it, they are not. They have slight differences. Now, bookkeeping and accounting are mostly used interchangeably, but it is good to distinguish between the two. However, before this could be done, it is necessary to know what financial accounting is. So before you can have a concise description of what bookkeeping and what accounting is, and be able to make distinction between the two, then we should be able to look into what financial accounting is. So what we are just saying, we are looking at the fundamental, and we are looking at what is bookkeeping and what are financial accounting. So financial accounting is the process of collecting, recording, presenting, analyzing, interpreting financial information for the users of financial statement. So what we are saying in essence is that financial accounting is that process. Is that process of collecting. It means you must be able to collect, record, present, analyze, and interpret what? Financial information. For what? For the users of financial statement. Meaning there are some people that will call the financial statement financial users. They are the ones that are in need of of that information you are preparing in that organization. Therefore, financial accounting is the process of collecting, of recording, of presenting, of analyzing, and of interpreting the financial information for the users of what of financial statement. So that is what financial accounting is. And we now say bookkeeping. Bookkeeping is just the art of recording the day-to-day transaction of many organizations. Now all the activities or process that will involve what just recording of all the transaction that goes on in that organization is what so called bookkeeping. Now accounting is the process of recording, analyzing, classifying, summarizing, communicating, interpreting in detail, reflecting all transactions involving the what the receipts, transfer, and disposition of the entity's fund and what and the property. So now this can also be a definition of what accounting. That accounting is the process of what of recording, analyzing, classifying, summarizing, communicating, and interpreting in detail, reflecting all transactions involving the record, the receipt, transfer, disposition of the entity's fund and property. That is that. Who are the users of financial statement? I mean, when we say the users of financial statement, we are talking about those people that are in need or that are interested in the financial statement of an organization. And I hope you know that if you say financial statement, we are saying that we are talking about what? We are talking about the profit and loss account and the balance sheet of that organization. So when we now say financial statement users, financial statement is of interest to a variety of users whose information need vary. Now the users are divided into two categories: the direct and indirect users. So now those people that are called financial users are they can group into two. They are direct users and indirect users. Now when we say direct users, who are they? Who are those people that are categorized under direct users? They are the owners of the business or the shareholders, the managers, the lenders, and the employee of that organization. These are direct users. But what about indirect users? For indirect users, we have the public, we have the suppliers, competition, and competitors, and the government. Now it's of note that you need to know that each of these users are in need of the financial statement for different reasons. Now the reason why the government are in need of the financial statement is quite different from competitors. Why the reason why the competitors are in need of financial statement are quite distinct from that of suppliers, and that of suppliers is different from public, and the public from the employee. So therefore, let us now look at the information requirements. What are the information requirements of these users of financial statement? These information requirements are one. Their information requirements are for the owners or the shareholders. They need the information regarding the performance of the firm. They want to know the performance of the firm. I mean the shareholders. I know the shareholders are the ones that contribute to the business. They are the ones that contribute their funds to for the existence or survival of the business. So therefore, why would they be interested in the profit and loss account and balance sheet of the business, which is the financial statement of the business? They are in need of it for what? Regarding for them to have good understanding of the performance of the firm. The next one is our managers. The managers need information on all aspects of the firm to know whether the business is progressing and the financial statement of the firm. Now the managers are the people that are running the business on behalf of the shareholders, and they need the financial statement for them to know maybe the business is actually progressing or not, and be able to know whether the business is progressing or not, and what again, and they be able to know the strength of the firm. Why the lenders are those people that borrow us money? Why are they interested in financial statements? They are concerned with information regarding the ability of the business to generate the liquid resources, or whether adequate assets are available as security. Now if I'm going to lend you money, who are the lenders? They are the banks, those organizations that lend money. If I'm going to lend you money, I want to know your asset base, to be able to know maybe you are capable of paying back or not. Because if you have good assets, then you'll be able to use it as collateral for the funds you want to collect, and from there you'll be able to move, you'll be able to get more credit. And that is that for lenders. They are in need of it for them to be able to make an informed decision of whether to grant credit to the organization or not. The employee are in need of the financial statement for they'll be able to argue for more pay and well condition and good condition of service. So because the more the profit, the more the condition of service, that's all things being equal. But if more increase in income of the organization is not translating into increase in income to the employee, then there is bound to be problem. And so how do they get to know that the company is performing well? They get to know through the financial statement, and from there they'll be able to agitate for more pay and good condition of service. The next set of people are the public. The public needs financial information to know whether they should invest in the enterprise or not. The public will be looking forward at investing in the enterprise, and how do they know? They know through the profit and loss account and the balance sheet of the business. Now they want to know how they have been faring in the past, so that they will be able to make an informed decision on whether to invest or not. Also, the public are in need of the financial system of the organization to be able to make them committed to social activities in their environment. It means they make the organization socially responsible by what? By drawing their attention to their environment. And how do they know that? How would they do that? They do that through the profit and loss account. They know that through the profit and loss account. If the business is making more profit, then they get to know that through the profit and loss account and balance sheet. And from there, they'll be able to tell them to be socially responsible to their environment. The next one is supplier. Supplier primarily needs information regarding the liquidity of the firm, as this will determine the firm's ability to pay goods supplied to it on credit. Suppliers are the people that are supplying goods to us on credit, and they need the financial information of the business to be able to know maybe they can still supply on credit or not. They want to know the credit worthiness and how faithful is the organization to be able to pay or what to make good of its promise of paying back what is debt as and when due. The next one is competitors. These are the people that are close rivals to the organization, like 7-Up and Coke. You know, they are good rivals. They are rivals. Now, 7-Up will be looking forward to Coke to see the financial statement of Coke, so that we'll be able to know what price is going to charge and its strength or position in the market. So because they are two rivals, and Coke, they know that is the determinant of that industry. So that because they are the leading firm in the industry. So they will be looking at their forward to see their financial statement to be able to know what are the price they are going to charge and what is their own position in the business. These are competitors' needs of the financial statement. Right. The next one is the government's needs. The government will need financial statement of the company to determine the amount of tax payable by them. The more the income of the organization, the more the tax they have to pay. That is the reason why government are in need of the financial statement of the firm. Now, what are the purpose of accounting information? Now, the accounting information, the first purpose is that it provides complete records of every transaction that goes on in the organization. If the accounting information will provide complete records of every transaction that goes on in the organization. It also provides an arithmetical check on the record. Since the double entry principle states that for every debit entry there must be corresponding credit entry. So therefore, the debit entry should be equal to the credit entry, and this in itself brings about arithmetical check on all the postings or all the transactions in the organization. That's another purpose of accounting information. The next one is that the financial information reduces the risk and facilitates the detection of errors and fraud. The financial information will be able to help us in detecting or a quick determination of errors and fraud in the organization. And that's that. So another purpose of accounting information are the preparation and balance sheet showing the assets and liabilities of the company. The financial position of the business at any given time can be ascertained through the preparation of balance sheet showing the assets and liabilities of the company. The financial position of the business can be through the preparation of the balance sheet showing the assets and liabilities of the company. The financial position of the business at any given time can be ascertained. So it means the financial position of the business can be ascertained through the balance sheet, because balance sheet of a company shows of a business shows the position, the true position of the business as at a given period, given end of the year, as a given period. That is that. Let's now go to the next one. Range of services provided by an accountant. So an accountant can provide the following range of services. The first one, they can write up the books of accounts and preparing financial accounts. They can write up the book of accounts and prepare final accounts. So they can also be employed. They can be employed in writing a book of accounts and prepare the financial statements. Now the next one is statutory audit of financial statement. They can also serve as an audit. They can audit the financial statement of the business. The tax computation, planning and returns. They can also handle the tax aspect of the business. They can what? The tax aspect, they can what? They can liaise with government and what? On behalf of the what? Of the business, in respect of the tax of that business. Liquidation and receivership, they can help in the liquidation of the business and what? And receiving or what? Or selling of what? Selling and receiving the what? The proceeds from sales of what? Of the assets of the business. For the purpose of what? Of distributing to the stakeholders of the business. So they can also perform sectorial services. They can also perform the investigation of irregularities. They can also what? Investigate irregularities in the business. They can set up accounting and internal control system. So their function is also to set up the accounting and the internal control system of the business, and also they can prepare the feasibility study report of a business, and can be employed in what? In recruiting the staff of an organization. So those are the what? The range of services that can be provided by the what? By the accountant. Now, what are the basic accounting concepts and conventions? Now, when we say accounting concept and convention, what do we mean? Accounting concept and convention, what do we mean? Now, financial accounting is not an end to in itself. It provides information to various users of financial statements. Many of these users have conflicting information needs. Now, over the countries during which the financial accounting profession has developed, a body of of principle has developed to regulate the practice of the profession, so that the preparation of financial statements that are guided by consistent and objective principles. Now, what we are saying now is that there are some principles, or there are some underlying principles that need to be followed, that will need to guide an accountant in the preparation of the financial statement. I mean the profit and loss account and the balance sheet. Now, these principles need to be borne in mind when they are preparing the financial statement. These people are what we call the concept and convention. Now, so these are the rules and regulations or principles that guide the preparation of the financial statement of a business. Now, this principle, known as concept and convention, are so fundamental that their application has come to be taken for granted. Now, what we are saying now is that the principles are very fundamental to the preparation of the financial statements, to the extent that their application has come to be taken for granted. Now, they have been accepted and issued in the form of accounting standard by such bodies as International Accounting Standard Committee (IASC) at the international level of the Nigerian Accounting Standard Board (NASB) in Nigeria. So now what I say now is that the rules and regulations or the principle that guides the preparation of the financial statements in a business is what called the accounting concept and convention. Let's look at them one by one. The accounting concept and convention. The first one is entity concept. Now, this concept explains that every economic unit or business, regardless of its legal form of existence, is treated as a separate entity from parties having economic interest in what's in it. Now, what entity concept is just saying is one of the assumptions of accounting. It's just saying that a business explains that every economic unit or every business must be treated as being different from that person that have a proprietary interest in it, or they have an economic interest in it. What is just saying is just that when you have a business, you should assume as an accountant, you should assume that the business is different from the owner. Now, you should not just have a business and start removing money from the business anyhow. That is against the concept of entity. Entity is saying now is that the business should be treated as being different from the owner, as being different from the person that have economic interest in it, as being different from those that have proprietary interest in it. So that's the economic entity concept. I will say going concern concept. Going concern concept is a concept in accounting which states that if a method is used in an organization, the method should continue to be in usage forever. No, I mean, going concern. I'm sorry. Going concern is just saying that a business will continue to exist in perpetuity without the owner or the person that has an economic interest in it having the mind of containing any significant part of the business. It means if you're having a business, you should not have it at the back of your mind that at some period you want to stop the business. No, it's against the concept of going concern. What are they saying in going concern? It's saying that going concern, the assumption is that The business until unit, the business unit to what will continue in perpetuity. I mean, continue forever. That is, a business is not expected to be liquidated or stopped in the foreseeable future. So it means, as an owner of a business, you should know what? You should not have the intention of stopping the business in the foreseeable future or soonest. So, going concern is just saying that what? You should what? A business concern should continue to be in existence forever, without the owner of the business having what? The intention of what? Of stopping the business or curtailing any significant part of what? Of the business. That is what going concern is just telling us. The next concept is periodicity concept. When we say periodicity concept, it simply means that what? It simply means that although the result of the business unit cannot be determined with precision until what? Until its final liquidation. Now, the business community and users of financial statement requires that the business be divided into accounting periods, usually 1 year, and that changes in position will be measured over these periods. Now, periodicity is just saying that the years of what? Of the business, usually the accounting business, the business be divided into what? Into accounting period. It means that what? You should divide the business into what? Into period, into which what? During which what? Changes in what? In position it was is determined. Now, like the concept they adopt in Nigeria is what? The internationally adopted is what? The period they adopt is 1st January to what? To 31st December. This is the period that what? The profitability or otherwise of the business is determined, and the statement of and the worth of the business is determined. So now it means the life of the business is divided into periods. Usually a year, that's what is in vogue. They will divide into a period, into which one after at the end of each period, the changes in the what? In position of the business should be measured over this period. Like in 2001 now, as we were in 2001, 2002, 2003. Now for 2001 now, for 2002, 2001, 2001 it will be 1 January to what? To December 30. So this is a period. Another for 2002 it is what? 1 January, from 1 January to what? December 30. This is another period. The third one is what? 4 January of 2003 to December 30. So this is first period. After this end of this 2001, you determine the changes in position of the business. The next time you can determine is after the next period. So if you are dividing the business into periods, and you are now noticing or what? You are now observing the changes in in position, or you are measuring changes in in position of the business over this period, then you are complying to what we call periodicity concept. The next one, which is the realization concept. Realization, the concept establishes the rule for the periodic recognition of revenue as soon as it is capable of objective measurement. Now it means realization concept means that what? It really talk about what? Recognition of the revenue. That revenue should be what? Should be recognized as soon as it is possible for you to objectively measure that revenue. So if it is what? Imminent that what? We can objectively measure a revenue, then the concept establishes the rule for the periodic what? Recognition of what? Of revenue as soon as what? As soon as it's capable of objective measurement. Now the value of assets receivable in exchange is reasonably certain. It is possible to what? To recognize revenue at a variety of points, e.g. where goods are what? Where goods are produced, e.g. where goods are produced, when goods are what? Delivered, when goods are delivered, or what? Or when the transactions are completed. So now what we are saying now in essence is that what? The value of assets receivable in exchange is reasonably certain. That is why you can say you want to realize. Now the concept of realization is just telling us the time in which we need to realize our revenue. That the concept establishes the rule for the periodic recognition of revenue. That you can only recognize your revenue only when it is what? You can objectively measure it, capable of objective measurement. That is realization concept. The next one is matching concept. The simple explanation of matching concept is just that what? The revenue is saying that the revenue of a period of a business should be matched with the expenses of that period, so that you can determine the profitability or otherwise of a business. It's just saying that what? All the revenue, all the income that relate to a period is what you should be what? You should charge against what? Against the expenses that relate to the same period, before you can say you are determining your profits for that period. As we are talking about year 2000 now. Now, your revenue for 2000, you cumulate it, your expenses you cumulate it, you subtract it, then you get your profit. What it is just saying now is that what you should just match only the revenue and the expenditure of a period together for us to be able to determine the profitability of a business. It's meaning that what you should not go and bring what the revenue for 1999 and bring it into what into 2000. No. Or you should not go and bring the revenue for 2001 and bring it into 2000. No. It is only the revenue that relates to 2000 alone that you should what that you should relate to the expenses of the what of 2000, so that you can determine the profit of what of the business. So that is what matching concept. Matching concept is just saying that what that the concept holds that for any accounting period, the end revenue and all the incurred costs that generated the revenue must be matched and reported for the period. He said it's not watched, it is what must be matched and reported for the period. It means it is the revenue and the cost for the period that should be matched for you to determine the profit of the period. That is that. The next one is what consistency concept. When I say consistency, usually there is more than one way in which an item may be treated in the account without violating accounting principles. Now the concept of consistency holds that what when companies select a method, it should what when companies select a method, it should continue unless conditions warrant a change to use the method in subsequent period, so that what a comparison of accounting figures over time is meaningful. What we are saying now is that there are different ways or different methods of treating an item in an organization. And what we are saying under this consistency concept is just saying that what is saying that what when a method of treating an item is what is selected by an organization or by a business, that method should be continuously used without having the mind of changing it, unless it has been proven otherwise that what it cannot show the true and fair position of the business. That is why you cannot change the method. So it means it should be consistent, so that accounting figures over time is meaningful. So example of this is when you are treating depreciation. There are different methods of adjusting for depreciation. The first one is what you can have reducing balancing method. You can have some of the year digits method. You can have straight line method. All these are methods that can be used to what to adjust for what to adjust for the financial to prepare the to determine the depreciation of a business. But if a business selects reducing balancing method, if that is what they select, reducing balancing method, it means what this consistency is saying now is that this method should continually be in use without the business changing it, unless they realize that this method is not suitable for the time for ascertaining their profit again. That is when they can now change it. Otherwise, they should continue to be in use. That's that. The next one is historical cost. When you say historical cost, the historical cost concept holds that what cost is the appropriate basis for initial accounting recognition of all asset acquisitions, services rendered, expenses incurred, creditors and owner interest. Now what we are saying now is that all assets acquired, all services rendered in an organization, the only way you can recognize them is through cost, and that cost is what we call historical cost. You talk in terms of the assets you acquire, in terms of the cost of the assets. You talk in terms of the services you render, in terms of the cost of the services. It means the historical cost concept holds that what cost is the appropriate basis for initial accounting recognition of all asset acquisition. The next one is what substance over form. When you say a substance over form, it simply means that what the reality of a transaction should prevail over the legality of that transaction. What this is just say, let me just give you a clue into what this is just supposed to mean. Assuming you are in a business and you have a case, with a debtor that need to pay you. Assuming the debtor is to pay you 2 million naira, and what will not happen is to pay you 2 million naira, and he decides to pay you 1.8 million. Remaining 200,000. He's not saying that it's not to pay what the 200,000. Now, normally, for you to get this 200,000, you need to take him to court and go through legal proceeding to get this 200,000. And if it happens that the amount you are going to get this 200,000 to pursue this 200,000 is maybe probably 500,000, which implies that you want to use 500,000 to collect 200,000 from your debtor. So what is substance over form is just saying that the legal aspect of it is that you want to use 500,000 to collect 200,000. You want to collect 200,000. That's the legal aspect, and you want to go through the court proceedings. But the real situation is that you are using 500 to get 200, which is not economical enough. It is not sensible enough. So therefore, what substantial platform is now saying now is that you should have a way of what? Of settling out of court, so that you can get this money, so that you can go all in the name of you pursuing the word 200,000 and eventually spend 500,000, which means that you are not really prudent enough. So that is what substance over form. You can explain it in that form. The next one is objectivity. Now the principle connotes what? Independence of judgment on the part of the accountant preparing the financial statement. Now, objectivity requires support by verification evidence, in contrast to objectivity or dependence on the unverifiable opinion of the accountant. What you are saying now is that every transaction in an organization should be substantiated with verifiable evidences. It should be objective. It should be objective in every activity or transaction in an organization. That's what objective concept is just saying. That we should always be objective in our dealings, in our business entity. So that is that. For fairness is what? Is a continuum of objectivity. It's just simply saying now is that when you are preparing your financial statement, you should not prepare it to favor a group, a set of a group. You should not prepare it. I mean, we are having different sets of users of financial statement. We are having the shareholders, we are having the government, we are having the management. Now what this is saying now is that as an accountant, the financial statement you are going to prepare to follow fairness is that you should prepare the same financial statement that will not favor any of these group, that will not be biased to any of these group. It should be the same thing you prepare for management, that you prepare for government, and you prepare for the shareholders. So that is when you say you are fair in your dealings. That is fairness. The next one is is materiality. When you say materiality, what do you mean? The principle holds that only item of material values are accorded their strict accounting treatment. Amount treating out to P&L is material to some organization, while it is immaterial to another organization. So what we are saying under materiality concept is that only item of material value are accorded their strict accounting recognition. Let me give you a scenario of the meaning of this. Now, if you have two organizations A, B, and let's say this organization is Nigerian Brewery, and this organization is Rofiko. They produce milk. Now you know that by the virtue of their largeness, you know that Nigerian Brewery is a very big company, while Rofiko is a smaller company compared to Nigerian Brewery. Now, if Rofiko buy a generator worth 500,000 naira, if Rofiko, which is company B, buy a generator worth 500,000 naira. Now, Rofiko will because it's a small company, will consider this 500,000 naira asset as equipment, as an asset, and he open an account for it. But for A, which is Nigerian Brewery, a big company, will consider 500,000 naira as just an expenses, and he will near expenses in his income statement by profit and loss account. So the way they are treating it simply means that to Rofiko, 500,000 naira is a material item. So he is able to accord strict accounting recognition to that 500,000 naira asset, because is material to them. It is much to them compared to their size. But for Nigerian Brewery, 500,000 is just a change, just minor amount, and they are not they are not going to treat it as a capital expense. Rather, they would it's just an expenses. So therefore, materiality is just saying now that only item of only the principle holds that only items of material values are accorded their strict accounting treatment. Amount treating up to the P&L is material to some organization, while it is immaterial to another organization, depending on the amount involved. And expenses of 1,000 naira may be immaterial to firm A, but may be material to firm B because of the capital involved in both business. So that is that. So it means only item that a company C A company deal should be what? To be material. Should be that one. It should be what? To be material. Should what? Should be the one that they what? They should accord their word as strict accounting recognition to. The next one is what? Is prudence or conservation. Conservatism. This is a conservatism, please. Conservatism. This is conservatism. Now, this principle demand exercising great care in the recognition of profit. In the recognition, this is recognition, please. In the recognition of what? Of profit. While all known losses are adequately provided for. So it means what? Prudence is just simply saying that what? In an account, in preparation for the financial statement, an accountant should not anticipate income. If you have not received an income, then you should not say you have received it. But whenever you are seeing that you are going to have a losses in the subsequent period, or the losses is imminent, then you need to adequately provide for that losses. So it means you are prudent. You should not say that, okay, my friend has promised me, our client has promised us 500,000 naira next week. You now quickly record in your financial statement. That is not a prudent idea. Prudent idea is just that you should ensure that what you don't put what they promise you, or you anticipate any income. Not until when the income are actually materialized, you actually receive it. That's when you record it. But that's when you recognize it. But if you are saying that you are going to incur losses as soon as possible, then you should try to quickly put it in your book, in your account, your financial statement, that is going to be a loss in a particular. So that is what we call a prudence, or you are conservative. That is what we call conservatism or prudence. The next one is what? Double entry concept. We say that what? For every credit entry, there must be a corresponding debit entry. It means in an accounting, for every credit entry, what happened? There must be what? A corresponding debit entry. Now let's now go to what? Accrual concept. Now, accrual concept as a corollary to the above, expenses incurred for the change again must be charged against the what? Income and to determine the profit or loss of that firm. You see that what the expenses incurred for the work must be what? Must be charged against the income and to determine the profit or loss. So determine the profit or loss of the firm. That is that. Let's look at preparation of account. No, that's that, please. That's that.